Something shifted last week that most people scrolled right past. While headlines focused on the immediate drama, ships rerouted, energy markets volatile, politicians issuing statements, the deeper signal was being sent through the financial system itself. A signal about the fragility of the structures we've built our economic certainty upon. I'm not here to tell you the sky is falling. I'm here to tell you that the ground beneath global finance just became less stable, and if you hold assets meant to protect wealth, or if you've been watching from the sidelines wondering when to act, this moment deserves your full attention. The disruption at the Strait of Hormuz isn't just about oil tankers or geopolitical tension. It's about what happens when a single choke point threatens the flow of resources that underpin the global economy. And more importantly, it's about what this reveals regarding the systems we depend on: monetary policy, currency stability, supply chains, and the increasingly precarious balance between debt and growth. Let me be direct with you. This isn't a call to panic. This is a call to understand. Because understanding is what separates those who preserve wealth from those who watch it evaporate during transitions. If you already hold gold, hard assets, or hedges against monetary instability, you're likely experiencing a mix of validation and concern. If you don't, you're probably wondering if this is the moment everyone warned you about, or just another crisis that will blow over by next quarter. Today, I'm going to walk you through what's actually happening, why it matters more than the news cycle suggests, and what disciplined investors do when the world reminds them that stability was always an illusion. The Strait of Hormuz carries roughly 1/5 of the world's petroleum supply. When that flow is disrupted, whether by conflict, accident, or political maneuvering, energy prices don't just rise. They signal something deeper to the financial system. They signal constraint. For the past 15 years, since the financial crisis of 2008, the global economy has operated under one fundamental assumption: that central banks could print, spend, and stimulate their way through any problem. That liquidity would always be available. That markets would always be supported. But liquidity doesn't create oil. It doesn't move cargo ships. It doesn't manufacture microchips or grow wheat. And when physical constraints meet monetary expansion, you get the kind of inflation that doesn't respond to interest rate adjustments or forward guidance. You get the kind that changes how people think about money itself. What we're seeing now is the collision of two forces. On one side, decades of monetary expansion, debt accumulation, and the assumption that paper assets denominated in fiat currencies will hold value indefinitely. On the other side, the physical reality that the world runs on real things: energy, commodities, labor, and those things can't be conjured by central bank balance sheets. The Hormuz situation is a catalyst. It's not the cause of the underlying instability, but it's the match near the kindling. And smart investors understand that when matches start falling, you don't debate whether the spark will catch. You acknowledge the conditions that make fire likely. Here's what the average investor hears when news like this breaks: crisis, panic, uncertainty, wait for clarity. And here's what they miss: by the time there's clarity, the repricing has already happened. Markets don't wait for certainty. They front-run probability. They move on the shifting landscape of risk, not on confirmed outcomes. And the shift we're seeing now isn't about whether the Hormuz situation resolves in 2 weeks or 2 months. It's about what that situation reveals regarding systemic vulnerability. Most people think about crises in binary terms. Either something breaks or it doesn't. Either we have a recession or we don't. Either inflation returns or it's under control. But the investors who preserve wealth through transitions think in probabilities and position sizing. They ask, what's the range of possible outcomes? What does my portfolio look like in each scenario? Where am I most exposed? Where am I protected? And right now, the probability distribution has shifted. Not dramatically enough that the mainstream narrative has caught up, but enough that those paying attention are adjusting position. The reason most people will miss this is that they're conditioned to wait for permission from authority, from the Federal Reserve, from their financial advisor, from the consensus view in mainstream media. They wait for the all-clear signal or the 5-alarm warning. What they don't understand is that by the time consensus forms, early positioning opportunities have closed. The gold that was $1,900 an ounce is $2,400. The Treasury yields that offered protection have inverted. The dollar-denominated assets that seemed stable have revealed their sensitivity to currency depreciation. I'm not telling you to front-run blindly. I'm telling you that understanding shifts before they become obvious is the difference between protecting wealth and scrambling to protect wealth. Let's zoom out for a moment, because what's happening at Hormuz doesn't exist in isolation. It exists against a backdrop that's been building for years. Since 2020, global debt has exploded. Governments printed money at a scale that would have seemed impossible a decade ago. The United States alone added trillions to its balance sheet. The European Central Bank, the Bank of Japan, the People's Bank of China, all of them expanded money supply dramatically. That money entered the system. It inflated asset prices. It kept zombie companies alive. It papered over structural problems in the economy. And for a while, it seemed to work. Stock markets hit records, real estate soared. People felt wealthy because their portfolios showed larger numbers. But here's what that expansion created: sensitivity. When you expand money supply faster than productivity grows, you create a gap. That gap is filled by debt and by the assumption that future growth will make current obligations manageable. But when physical constraints appear, when energy becomes more expensive, when supply chains break, when geopolitical instability threatens the flow of essential goods, that gap becomes visible. Suddenly, the money you printed doesn't buy as much. The debt you accumulated becomes harder to service. The asset prices that seemed solid reveal themselves as nominally high, but purchasing power questionable. This is where we are now. Not because of one event, but because of 15 years of monetary expansion, meeting the reality of a physical world with constraints. Interest rates rose over the past 2 years, but they rose into an economy that had become dependent on cheap money. The result? Stress in regional banks, stress in commercial real estate, stress in highly leveraged businesses, stress in emerging markets with dollar-denominated debt. The Federal Reserve and other central banks found themselves in an impossible position. Raise rates to fight inflation, and you risk breaking the debt structure. Lower rates to support the economy, and you risk currency devaluation and further inflation. This is what's called a monetary trap. And the Hormuz disruption has just made that trap tighter, because now you have potential energy inflation on top of structural inflation. You have supply chain uncertainty on top of already fragile global trade. You have geopolitical risk on top of already stretched fiscal positions. The question isn't whether central banks will respond. They will. The question is whether their tools still work in this environment. And more importantly, whether their response, likely more liquidity, more spending, more debt, actually solves the problem or simply delays the reckoning. If you study financial history, you'll notice a pattern. Periods of monetary expansion eventually meet constraint. And when they do, the flight to real assets accelerates. In the 1970s, it was the oil shocks combined with dollar debasement after Nixon closed the gold window. Gold went from $35 an ounce to over $800, not because of hype, because people lost faith in the purchasing power of currency. In the late 1940s, after World War II, it was the combination of massive war debt and rebuilding needs. Currencies reset. Gold held value. Those who understood monetary history protected wealth. Even in more recent history, 2008 to 2012, we saw gold rise from $800 to over $1,900 as central banks responded to the financial crisis with unprecedented monetary expansion. The asset didn't rise because of speculation. It rose because investors recognized that the money supply was being debased and that real assets would be repriced accordingly. Each time the pattern is similar. First, there's a crisis or constraint. Then there's a monetary response, print, spend, bailout. Then there's a lag where it seems like the response worked. And finally, there's a repricing as people realize that expanding money supply doesn't create real wealth, it just redistributes purchasing power. We're in the repricing phase now. Or more accurately, we're at the beginning of it. What's different this time is the scale. The debt is larger. The monetary expansion was more extreme. The global economy is more interconnected, which means shocks transmit faster. And the geopolitical landscape is more fragmented, which means coordinated response is harder. The Hormuz situation isn't the cause. It's the catalyst that's forcing people to look at the underlying structure and ask, is this stable? Can this continue? What happens if the assumptions we've made about growth and liquidity turn out to be wrong? History doesn't repeat exactly, but it rhymes. And right now it's rhyming with periods where currency instability meets resource constraint, and where investors who positioned in real assets before the repricing protected wealth, while those who waited saw purchasing power erode. If you already hold gold, silver, or other hard assets meant to hedge against monetary instability, you've likely felt vindicated recently. Prices are rising. The thesis is playing out. But let me offer you something more important than validation: caution. This is not the time to get emotional. This is not the time to assume you were right, and therefore everything will continue in your favor. This is the time to remain disciplined. Yes, the probability has shifted in favor of real assets. Yes, the monetary conditions support further repricing. Yes, the Hormuz situation adds fuel to the thesis. But markets don't move in straight lines. There will be pullbacks. There will be moments where it seems like the old paradigm is reasserting itself. There will be statements from central banks or temporary resolutions to geopolitical tensions that cause price corrections. Your job isn't to predict every swing. Your job is to understand why you hold what you hold and to maintain that position through volatility if the underlying thesis remains intact. If you bought gold at $100 because you believed in monetary debasement and currency instability, don't sell at $2,300 because it went up. The conditions that made it valuable haven't disappeared. They've intensified. But also, don't overconcentrate. Don't become so convinced of a single narrative that you ignore risk management. Don't leverage up because you think you found certainty. There is no certainty, only probability. What you should do is review your position size. Make sure it still makes sense relative to your overall portfolio and risk tolerance. Make sure you're not holding out of FOMO or emotion, but out of clear-headed assessment of the macro environment. And prepare yourself psychologically for volatility. Because even in a bull market for hard assets, the path is never smooth. If you don't currently hold gold or other monetary hedges, you're probably asking yourself a critical question. Is it too late? Let me give you an honest answer. I don't know. Nobody does. What I can tell you is this. If the thesis is correct, if we're in a period of currency instability, debt saturation, and resource constraint, then the repricing has further to run, possibly much further. Gold at $2,300 might seem high if you remember when it was $1,200, but if you measure it against the money supply, against global debt, against the historical ratio to financial assets, it's not expensive by long-term standards. The question isn't whether it's gone up. The question is whether the conditions that drive it higher are still in place and intensifying. Based on what we're seeing, escalating debt, no credible path to fiscal sustainability, geopolitical instability, energy constraints, inflationary pressure that central banks can't fully control without breaking the economy, those conditions are not only in place, they're worsening. But here's what you absolutely must not do. Chase, panic buy, go all in because you're afraid of missing out or because you think a crisis means you have to act immediately. If you don't hold real assets and you think you should, the right move is to educate yourself first. Understand what you're buying and why. Understand the risks. Understand that even if the long-term thesis is correct, the short-term path includes volatility. Then, if it makes sense for your situation, build a position gradually. Dollar cost average if that helps you manage emotion. Start with a size that lets you sleep at night, not one that requires you to be right immediately. The worst thing you can do is enter a position out of fear or FOMO, watch it pull back 10 or 15%, panic, and sell at a loss. That's not investing. That's gambling with poor risk management. Remember, the goal isn't to catch the bottom or maximize short-term gain. And the goal is to have appropriate exposure to assets that perform well in the macro environment we're entering. And that environment appears to favor real assets over financial assets, denominated in depreciating currencies. But only if you approach it with discipline, education, and appropriate position sizing. Let's talk about what actually moves markets during uncertain times. Because it's not fundamentals alone. It's the interplay between fundamentals and psychology. Right now, most investors are in what I'd call reluctant recognition. They see the signs. Inflation isn't fully tamed, debt keeps growing, geopolitical risks are real, but they don't want to believe the old playbook has stopped working. They want to believe that central banks still have control, that the dollar will remain stable, that financial assets will keep going up because they always have, that this is just another dip to buy. And maybe they're right. Maybe all of this resolves cleanly and we return to the low-rate, high-growth, stable currency environment of the 2010s. But the probability of that outcome is shrinking. And as more investors recognize that, the flow into real assets accelerates. Not because of hype, but because of repositioning based on changing probability. This is how sentiment shifts work. Slowly, then suddenly. For months or even years, a minority position seems fringe. Then, as evidence accumulates and conditions worsen, the minority becomes a growing minority. Then, at some point, it becomes consensus. We're not at consensus yet. Most financial advisors still recommend 60-40 portfolios. Most retail investors still hold primarily stocks and bonds. Most institutions still operate under pre-2020 assumptions about monetary policy and market structure. But the shift is beginning. And the investors who recognize it early, who position with discipline before the shift becomes obvious, are the ones who protect and grow wealth during transitions. The psychology you need to cultivate is this: comfort with being early. Comfort with looking wrong for a while before being proven right. Comfort with missing short-term gains in areas you've exited in order to protect against long-term losses. This isn't easy. Humans are wired for conformity and immediate gratification. But wealth preservation requires going against both instincts when the facts demand it. Let me be very clear about what you should not do in this environment. Do not panic. Panic is the opposite of strategy. If you're feeling acute fear or urgency, step back, take a breath, give yourself time to think clearly. The worst financial decisions are made in emotional states. Do not chase headlines. The Hormuz situation will evolve. There will be escalations and de-escalations. There will be days when it seems critical and days when it fades from the news. Your investment thesis should not change based on the daily news cycle. Do not over-leverage. If you believe in real assets, own them outright or with minimal leverage. The investors who get destroyed in volatile markets aren't the ones who are wrong about direction. They're the ones who are right about direction but wrong about timing and leverage. Don't be that person. Do not follow online hype or influencers promising certainty. Nobody knows exactly how this plays out or on what timeline. Anyone who tells you they do is selling something, usually their own credibility or product. Make decisions based on your own research and risk tolerance. Do not ignore the rest of your financial life. Your emergency fund still matters. Your income still matters. Your overall financial plan still matters. Real assets may be an important part of your portfolio, but they're not the only part. Don't become so focused on one thesis that you neglect basic financial health. Do not try to time perfection. You will not buy at the absolute bottom. You will not sell at the absolute top. Trying to do so will drive you crazy and likely cause you to miss the major move entirely. Focus on being approximately right, not precisely perfect. And finally, do not make major decisions without education. If you don't understand what you're buying, why you're buying it, and what risks you're taking, you're not investing. You're speculating. And speculation without understanding is just expensive education. The disruption at the Strait of Hormuz is not the story. It's a chapter in a much larger story about monetary systems, debt saturation, resource constraints, and the repricing of assets in an environment where currency stability can no longer be assumed. You're watching the early stages of a transition, not a collapse, not the end of the financial system, but a transition where the rules that governed the past decade may not govern the next. Your responsibility as a steward of your own wealth is to understand this, to position appropriately, and to maintain discipline regardless of short-term volatility. If you hold real assets, stay calm and stay positioned. If you don't, educate yourself and consider whether your current portfolio makes sense in the environment we're entering. But above all, resist the urge to react emotionally. Resist the urge to follow crowds. Resist the urge to seek certainty where none exists. The investors who thrive through transitions are not the ones who predict the future perfectly. They're the ones who understand probability, manage risk intelligently, and maintain emotional control when others are losing theirs. This moment matters, not because it's the end of something, but because it's the beginning of something. And how you respond now, with patience, with education, with discipline, will determine whether you look back on this period as one where you protected wealth or one where you watched it erode. Stay informed, stay rational, and remember that understanding cycles matters more than reacting to noise. Thank you for your time and attention.